No matter how optimistic or maybe even delusional Wall Street pretends to be, economic data for this year continues to keep us humble and uncertain. We're going to cover the overall encapsulation of what things have looked like economically so far this year in 2023. And we're going to lay that out in order to give a framework and an overall guidance on where you should consider putting your money and where you should possibly be investing. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity. So right out of the gate, CPI numbers have been trending downward overall since the Fed rate hikes have kicked in back in second quarter of 2022. But inflation is starting to get resistant. And the Federal Reserve had just gotten to a point where it was starting to pull off the gas pedal with its rate hikes. We're down from 0.75% rate hikes back to back down to a 0.25% rate hikes in recent times. And the CPI data information may be putting the Fed in a position where they're going to have to put their foot back on the gas. Wall Street had priced in for the Federal Reserve to pretty much stop the hikes sometime this month in February of 23 or maybe in March. Now projections are being pushed out that the Fed may be raising rates through June. This puts us at multiple 0.25% rate hikes coming that the stock market and Wall Street have had to price in recent days. Unemployment is still at record lows, which has also given the Federal Reserve ammunition to continue to raise rates as inflation continues to stay resistant. The stock market and Wall Street has also been looking to retailers to try to gauge consumer sentiment. And the reality of that situation has been murky at best as well, because the data there has been showing that consumers are still spending in certain ways, but at the same time, savings rates are depleting. Credit card debt is shooting through the roof, as well as auto loan defaults are also kicking in at a high rate. So you're seeing a situation where consumers are spending money still, but at the same time, where are they spending that money from? Where's the money coming from that they're spending? That's the question. Right now, it looks like they're running through their savings, starting to lean on credit cards at a really alarming rate. So with all of this data coming in, you also have to understand the Federal Reserve raising rates as it's been doing is going to continue to also create a strong dollar, which has its own economic impact domestically and internationally. Where does this leave you with your decision making on your finances right now? Depending on where you are right now, if you're sitting in cash, do you want to consider short-term CDs? No more than 9 months, somewhere between 3 and 6 is ideal. You can find specials all over the place at these terms. Gives you FDIC insurance, and you don't have to worry about tying your money up somewhere where you could be risking your principal. Stock market is going to be extremely unsteady for the foreseeable future. If you have a strategy going in the stock market, then go for it. But if you're not already there, you don't have a winning strategy in place already, you may want to consider short-term CDs, high-yield savings accounts to keep liquidity, or at least to keep your principal protected and get a reasonable return. You have to remember, one of the side effects of the Federal Reserve raising rates is strengthening deposit rates. As I mentioned in a previous video, for the first time, deposit rates are actually starting to compete with the official CPI numbers and overall inflation numbers, meaning that you actually can keep up with inflation for the first time in a very long time simply in deposit products. As the Federal Reserve continues to hike, whether that's 0.25%, 0.5% rate hikes, that means deposit rates are going to likely go with it. On the flip side, when you start to look at investment strategies, the stock market, again, it's going to be a rough place to be unless you can do your homework and due diligence and find companies or sectors that are benefiting from the current economic conditions. Then you can either consider dollar cost averaging into the broader S&P, or you may have to consider bonds. I've shot a video recently explaining the yield curve and how that yield curve works, and how it can help guide you on the most effective way to invest in bonds based on what's going on in the economy. The yield curve is basically a measurement of the return or interest rate on bonds that all have the same credit rating but have different maturity dates. Based on the direction of the economy, the yield curve goes in its own particular direction. And that indicator gives you an idea of where you should be within bonds. And it honestly gives you an idea where you should be overall in your investment and where the economy may be going. When you look at the real estate market, the Federal Reserve continuing to raise interest rates is going to have a very interesting effect because the real estate market is an utter mess right now, to be completely frank. You have a scenario right now where the federal government's doing everything it can to keep homeowners in their homes and minimize defaults and foreclosures. You already have an inventory shortage of millions of homes, and you have skyrocketing rents in many places. Though this is starting to cool off in some markets, the reality is rent is still going through the roof in many places. Interest rates are up significantly where they were a year and some change ago, and it's leaving many sellers not too enticed to sell, put their homes on the market to sell and end up having to buy into a more expensive mortgage. Because you have to remember, nearly 90% of current mortgage holders in the US have an interest rate lower than the current interest rate that's offered in the marketplace right now. So this just doesn't leave many incentivized to sell unless they have to. You have the situation of the government stepping in, minimizing defaults. That means you also won't have, a cascading landslide of desperate sellers hitting the marketplace either. People also have more equity in their homes than they've had in a really long time. So all of this is creating a scenario where you don't have a lot of supply. You also don't have the hottest buyer's market right now due to the fact interest rates are through the roof and prices are up through the roof in the last 2 years. And they have not come down subsequent to the interest rate hikes that we've seen in the mortgage market, relatively at least. So with all of this coming together, you also have to factor in the 10-year Treasury being a much deeper connection to mortgage interest rates than the Fed funds rate. So that basically means the Federal Reserve can continue to raise rates, but it's really all about the demand for the 10-year Treasury. And if that pulls down and pulls mortgage rates down with it, you could have a really imbalanced market again where you start to see bidding wars. Some people are already in markets where they're seeing multiple offers on properties, again, just from the small decrease in rates that we've seen in the last 6 to 8 weeks. So, as you can see, it's a mouthful. There's a lot going on out there in the economy. There's a lot going on in several different sectors where your money might normally be. I recommend that you don't commit to much of anything right now. If you do not have a winning strategy already in place, I don't recommend that you marry any investment strategy at this point in time. The next 3 to 6 months can tell us a lot about where things are headed. We don't know if we're headed into an official recession, how deep that recession will be if we do hit it. Can the Fed pull off a soft landing? How long will they continue to increase interest rates? How long will unemployment stay at a record low? And the list goes on. All of these things should be keeping you pretty reserved right now in your commitment to invest. This doesn't mean not to shoot for the best returns that you can get, but it does mean to be mindful that things are shifty out there right now. You don't want to take unnecessary risks. I wanted to shoot this video to take the time out to help put perspective in place for you. The Fed's next meeting, I believe, is going to be March 22nd of 2023. We're going to get more economic data in the first couple weeks of March as well. And this is going to have a huge influence on the direction the Federal Reserve goes with their next meeting and their next rate hike decision. So I'm going to continue to do as I always do on this channel and bring you the latest information and bring you a little perspective with that information so you can make use of it. I hope you found value in this video. I'm confident you did. I enjoy bringing you the content as always. I want you guys to continue to stay focused, stay in motion. I'll see y'all soon.